afternoon, all of you. Till the last class, we have done sums on modified internal rate of return. So we have finished all the discounting techniques, that is NPV, IRR, payback period, discounted payback period, profitability index, and modified internal rate of return. Just a second. So today we are starting with the non-discounting techniques. That is, the first one is accounting rate of return, which is called as ARR. It is also called as average rate of return, but usually we call it accounting rate of return. Now, why it is called as accounting rate of return? Because it depends on the accounting profits and not on the cash flows. So here we will be interested in profit after tax, which comes in the profit and loss account. So it is totally dependent on the accounting data. That's why we call it as accounting rate of return. Now, how to find accounting rate of return or ARR? The formula is average profit after tax divided by average investments into 100. How to find average investments? Average investment is equal to initial investment plus scrap divided by 2. If scrap is given, that is, scrap means the salvage value or the remaining value of the asset. If that is given, only then we'll use this formula. Otherwise, we'll simply divide it with initial investment. Because if scrap is not given and you will find the average, that means your investment will become half. You're just doing initial investment divided by 2, which is not correct. So you will not get a proper rate of return. Then how to find average profit after tax? It's nothing but the total profit after tax divided by number of years of the project. So let us do one sum and understand the procedure. Just 1 second, all. Okay. So first sum we will start with the accounting rate of return. How are we going to solve this? We'll see. First we need, the formula says average profit after tax divided by average investment. So average profit after tax we'll find first, which is equal to total profit after tax. I'll call it as PAT henceforth. PAT is nothing but profit after tax divided by number of years. So average profit after tax, average PAT is equal to, we need to total all this. So here itself I'll make one more column, or it's just adding all these. So 20 plus 40 plus 60 plus 90 plus 120. Once you add all that, you get the total profit after tax value. You have to divide it by the number of years. I'll just tell you how much we get the addition. Three lakh 30,000 we get if we add it. So the total is 3,30,000 divided by number of years. Now there are 5 years. So I'll do it divided by 5. So your average PAT will be equal to 3,30,000 divided by 5. We get 66,000. Okay, now the next thing is average investment. I told you you should do average investment only if the scrap is given in the problem. The scrap is not given, so we will just take the entire initial investment as it is. So I'll just put it in the formula. average profit after tax is equal to average PAT, which is 66,000, divided by initial investment, which is given here in the question, 1,70,000. Okay, so we will do divided by 1,70,000, and we need it in percentage, so we will multiply it with 100. Divided by 1,70,000 into 100. So the entire thing first we need to divide and then multiply it with 100. Sorry for the disturbance. So we'll do the average profit after tax divided by the number average investment, which I've taken as initial investment only. The reason being there is no scrap value given, so we are not finding the average of it. If we find the average of it, we'll simply do 1,70,000 divided by 2, which will make the investments half. So we are not doing that. So 66,000 divided by 1,70,000 if you do into 100. So your average profit after tax is 38.82%. That means, sorry, here it's not average profit after tax, it is accounting rate of return. So your ARR, that is accounting rate of return, will be equal to 38.82%. So how much did we earn in this year on the project? We have earned 38.82%. That is what we need to interpret when we get the answer of ARR. I hope the first problem was clear. If you have any doubts, you can ask. I have just totaled all the profit after tax to get the total profit after tax and then divided it with the number of years to get the average profit after tax. And initial investment into 100. Why only initial investment? Because scrap was not given. So there is no need to do initial investment divided by 2. If scrap is given, we add both and then we divide it by 2 and take the average investment. Any doubts anybody? Others will go to the next problem. Okay, let's start with the next question. Calculate accounting rate of return for the following projects. So they have given you initial investment and they've given you profit before tax. Just see here carefully. They've given you profit before tax, but we need profit after tax. The formula itself says average profit after tax. That is average PAT divided by the average investment into 100. So we have to first find the profit after tax. So for that purpose, if you observe, they have also given you the tax rate. So we will recreate the table and find the profit after tax. So we'll write here in 3 columns. One is year, one is profit before tax, tax and profit after tax. Totally 4 columns we will need. So we will write year, profit before tax, tax at 40% they have told. So we will calculate the tax. and then we'll get the profit after tax. Here we are not interested in the cash flows, we are interested only in the accounting profit after tax. So 5 years details they've given us. Okay, and we'll just take down the profit after tax here. Sorry, profit before tax. Now they have said that tax is 40%. So 40% of 1,25,000 we have to do to get the first year tax, that is 50,000. So of this amount, profit before tax, we have to calculate 40%, which is 50,000. Then 40% of 1,60,000 is 64,000. 40% of 1,80,000 is 72,000. Similarly, 40% of 1,50,000 is 60,000. And 40% of 1,20,000 is 48,000. So these are the tax values. Now what we have to do, we'll call them as column number 1, column number 2, column number 3. Now profit after tax is column number 4. And how do we calculate? So 4 is equal to 2 minus 3. That means profit before tax minus tax. We'll get the profit after tax. So 1,25,000 minus 50,000 will get 75,000. 1,60,000 minus 64 we'll get 96,000. 1,80,000 minus 72 we'll get 1,08,000. 1,50,000 minus 60 we'll get 90,000. And 1,20,000 minus 48 we will get 72,000. So now we have to total this column. So we want the total profit after tax. If you total this column, you will get 4,41,000. This is your total profit after tax. Now what we want is we need to find the average profit after tax and initial invest divided with the initial investment to get the accounting rate of return. So first we find the average profit after tax, which is equal to the total profit after tax 4,41,000 divided by the life of the project, which is 5 years. So 4,41,000 divided by 5 you get 88,200. Now we'll find the accounting rate of return, which is equal to average profit after tax, that is 88,200 divided by the initial investment, because here again the scrap value is not given, so we will directly take the initial investment amount. We will not find the average of it, so divided by 7,50,000 into 100. We calculate this, we will get the accounting rate of return, which is equal to 11.76%. 11.76. So this is the answer of ARR, or the accounting rate of return. So similarly, I have one more sum. We'll do that. We'll finish the concept of ARR. So remember, always for ARR we need profit after tax. We don't need the cash flows. Okay. So let me also explain you by looking at one of the previous sums. So let's just go to a sum where we have found out the cash flows. Just give me 1 second. Yes, this is the problem. Let me just copy it and redo it for you with ARR. Okay. We'll do it later. First, let me finish the given above problem. So they have told calculate ARR for the following projects. So let us do it for project A first. For project A, we need average profit after tax. Okay. which is given here, the profit after tax values 60 plus 75 plus 80 plus 55. This is the total profit after tax that comes to 2,70,000. So here 2,70,000 is the total divided by, now see the project is only for 4 years. So we are going to take the life as only 4 years. Okay, so because sixth and seventh year there are no cash flows. That means project A is there only for 4 years. So divided by 4, you'll get the average profit after tax as 67,500. Now we can find the accounting rate of return ARR, which is equal to 67,500 divided by the initial investment, which is given as 4 lakh. So 67,500 divided by 4 lakh into 100. ARR will be equal to 16.875%. So this was for project A. Similarly, we have to do it for project B. First, we'll find the average profit after tax. To find the average profit after tax, we need the total profit after tax. So this 5 years value we need to add here. So it's for 5 years. 56 plus 64 plus 78 plus 92 plus 99. We need to add all this to get the total. So the total is 3,89,000 and it is for 5 years now. So we have to take 5 years. So 3,89,000 divided by 5 years. You can write years here so that you don't get confused. So we will get the average profit after tax as 77,800. Now you can find the ARR, that is accounting rate of return, which is average profit after tax divided by, I'm doing it as initial investment because scrap value is not given. So we are not finding the average. We're taking the entire initial investment, 5 lakh rupees into 100. So ARR will be equal to 15.56%. Now let's do the same for project C. So for project C, average profit after tax is equal to, we need to see the total. Now this is project C and we need the total for all the 4 years, sorry 6 years. So we add all the 6 years and get the total as 4,83,000. So 4,83,000 divided by 6 years, 3,500. Then accounting rate of return is equals to average profit after tax 80,500 divided by the initial investment, which is 6 lakh rupees. So divided by 6 lakh into 100. So your ARR will be equal to 13.4%. So this is the rate that the company has earned on its projects. Okay, similarly we have to do for project D. Project D, we find the average profit after tax, which is equal to the total of 5 years here in the project. So all the 5 years total we have to take 75 plus 65 plus 40 plus 56 plus 48. So the total comes to 2,84,000. 2,84,000 divided by 5 years. We'll get the average profit after tax as 56,800. Now we'll find the accounting rate of return, which is equal to 56,800 divided by the initial investment again, because the scrap is not given here. So see, the initial investment is 4,50,000. So we're going to take this divided by 4,50,000 into 100. So we'll get the value of average profit after tax, ARR, is equal to 12.62%. So this was the average for all the four projects. Now, if they ask you to rank the projects, you have to check which has the highest. Project A is giving 16.87 returns, B is giving 15.56, 13.4, and 12.62. So if they want to accept, they have to accept project A because it's giving the highest return, 16.87%, then B, and then C and D. So this is how it would be also ranked. Okay, so here calculate, let's do the next sum. Calculate ARR for the following project. Initial investment is rupees 2 lakh. Return down value method of depreciation is to be adapted. The rate of depreciation is 20% and the tax rate is 50%. So this is how we had solved it. I'll just take the depreciation working note also from above. It's there here. It's there in the Excel. Just a minute. We'll do it now. So what I want to prove my point is what we have to consider and what not. Okay, so I'll just show you how we are going to work on this particular project. Tax. From this, we calculate depreciation and minus it. We get cash flow before tax. We minus tax. We'll get cash flow after tax. Or you can also call it as profit after tax. So this is what we need. We need not go to cash flows. We need not add back depreciation again. These two columns are not required because we are not interested in cash flows, but we are interested in profit after tax. So we will call it as PAT. So if they give question like this, where they give you the tax rate and the depreciation rate, and they ask you to calculate the profit after tax, you need not go up to cash flows. These are the columns that you will need: the cash flow before depreciation and tax, the depreciation. From that, you minus the depreciation to get the cash flow before tax, minus tax, and you will get the profit after tax or cash flows after tax. This last column we will total and we'll find the total PAT so that we can find the accounting rate of return. How to calculate depreciation for the same sum? I have shown it in when I was doing IRR, so I'm not repeating it here again. If you've seen that video, you will be already knowing how depreciation has been solved. I'll just total it, just 1 minute. 34,760 plus 33,308. So the total is 1,44,268. Okay, so this is your total profit after tax. Now we can find the average profit after tax, which is equal to 1,44,268 divided by 5 years, which is equal to the life of the project is 5 years. 28,853.6, which is 28,854. We can say this is the average profit after tax. Now we need the initial investment, so we'll take the average initial investment. I'll tell you why we are taking average here. Just give me 1 second. Just look at this. This was the depreciation working note which we had done, and I'll just copy it there as well so that it is there with us in the Word document. Okay, so before we solve this table, we usually find the depreciation first. And if you are observing here, depreciation at the end of fifth year, the written down value or the balance is 65,536. What is the 65,536? It is nothing but the depreciation amount, or you can say the salvage value which is remaining. Okay, now why the salvage value is remaining here? Because this much amount is not recovered. The life of the project is 5 years. Within 5 years, these are the balances of the asset. 65,536 is not depreciated and the project gets closed. So this 65,536, I will call it as salvage value or scrap. So scrap is equals to the remaining balance of asset, which is 65,536. Now that we have the scrap value, we need to find the average initial investment. The formula for average initial investment was initial investment minus, just a second, plus initial investment plus scrap divided by 2. So we have scrap now. So we are using the average initial investment. So the initial investment given in the question is 2 lakh rupees. So we'll just take that 2 lakh here, plus the scrap value. Scrap value is 65,536. 65,536 divided by 2. Okay, so it will be 2,65,536 divided by 2, which is 1,32,768. So equal to 1,32,768. So now we have the initial investment and the average PAT. So ARR is equals to average PAT was 28,854 divided by average investment 1,32,768 into 100. So ARR you will get it as 28,854 divided by 1,32,768 into 100. So we get 21.73%. So this is how you have to find the accounting rate of return if the scrap value is given And here in the question, they're not given, but when we did the depreciation working note, we found out that at the end, this much balance of the asset is remaining, which is going to be a scrap. Okay. And if they give you depreciation and tax rate, you have to just minus tax. Whatever you get is your profit after tax. There is no need to add back depreciation and go till cash flows, because initially only I told you accounting rate of return is dependent on the accounting profit. They are not bothered about the cash flows of the firm, but they are interested in the profit after tax which you get from the profit and loss account. So there is no need to add back depreciation and find the cash flows. After tax, whatever we get, that itself is our profit after tax value. If you have any doubts in this, please ask. I hope it was clear with everybody. Anybody having any doubts? Okay, the next method is the payback period. Ashwini is messaging constantly, ma'am, profitability index is not there in internals. No, it is not there, Ashwini. It's only the first two methods, that is NPV and IRR. Anybody else has any other doubts? Okay, the next method is payback period, which we will do in the next class. This is the last method, and after this, I'll be teaching you the